and look at some of the longer term structural issues, some of those issues positive. A lot of people look at what happened during the pandemic with regards to the economy, and they see major shifts here that are going to change how people invest, or at least what they gravitate to. Is there sort of a general strategy that you walk clients through for the next few years, given what we know now about the pandemic, about the economy, and everything in between?
Okay, so the general theme is that we focus on what is the time frame for your investment and what is your stomach lining or your appetite for risk. But clearly the sectors that are going to continue to flourish, even though today was a big hit in the technology sector, technology will continue to flourish. So unless we think tech is dead, today is a great buying opportunity, I believe. Things that do really well in inflationary times are the real estate market, the commodities, materials. These are all things. The healthcare sector, as long as we have a pandemic and we're still getting variants, the healthcare sector will continue to do well. So these are the things that we are focused on in the next 12 to 18 months. But from a longer term perspective, it's all about time frame and risk tolerance.
What is the bond market telling you then at 76 basis points on the 210?
She loves the bond market, Nancy.
About if we are really in that inflationary environment?
So I think we have to be very careful with fixed income. We know the Fed's going to taper, and we know interest rates will slowly begin to rise. So we must prepare for that. But in the meantime, there's been a great deal of volatility and unpredictability, but that's just part of the deal. Shorter durations and good credit is really always what you want to be very, very cautious with the fixed income. But you can't get out of fixed income altogether. So if you really love bonds, I'm for bonds, because you have to have some of those in order to keep your portfolio balanced, and you're not like a roller coaster ride. Especially this week, you would have definitely been in a roller coaster ride if you didn't have some balance.
Yeah, Nancy, I mean, Taylor loves her bond questions. I love a global question. Talk to us about whether the US is the only game in town when it comes to risk assets.
Well, I happen to think so. Not that I'm discounting or eliminating the rest of the world, but there's just so much opportunity here in the U.S. and a little bit more predictability, even though nothing is predictable, but a little more predictability here in the U.S. than any place else. And, everybody's all bent out of shape about inflation. And yes, we do have inflation, but it's not nearly as bad as when we were dealing with double-digit inflation back in the 80s. And it certainly isn't nearly as bad as it is outside of the U.S. Outside of the U.S. is experiencing significantly worse situation than we are. So I believe the best opportunity and the more stable investments will be here in U.S. for the time being.
Do you worry at all about the response by the Federal Reserve to some of the inflation numbers that we've had so far, as well as another big report coming up a week from today here? Do you worry at all, Nancy, that they are either going to make a policy mistake, or at least the market will interpret it as a policy mistake?
Well, I hope that they don't make a policy mistake, because they've had experience with this before. We've had inflation many times before, and we've been able to overcome it. So that I'm not nearly as concerned about. Is, well, the market reaction is usually a momentary thing, and then it reverts back to the mean. I think if all goes as planned, the slow tapering over a period of time, then we should be okay, because markets have already priced all that in. If the Fed becomes a little more scared of inflation and starts spiking rates maybe too quickly or too much at once, that could definitely have a significant and adverse effect on the financial markets.
And adding back to Caroline's question, when you think about a global story, is it not more attractive now, given some of the LATAM central banks are already hiking, and makes those assets now look relatively more attractive?
Well, again, be careful. What looks attractive is not necessarily attractive. Always keep in mind, what is the time frame and what are the goals, and then currency. Currency exchange plays a very big part when you're investing outside the U.S. The stability of the currency and what's going on during inflationary times. That is a huge consideration, but it really has to do with the individual situation more often than not.